One of the greatest value investors in India, Raamdeo Agrawal, is of the view that this decline is a godsend opportunity for long-term investors. Volatility is often a long-term investor's best friend, and he's of the view that it is time to buy right and sit tight. There is a mess in the global environment. Parallels are being drawn of what happened in 2008 and 2013 and 2011, and you are of the view that it is time to buy.
Yes.
You're serious about it?
I'm very serious about it. See, time to buy is always there if you have the money.
Yeah.
Okay. And this time it's not, there is a decline, there's a global synchronized decline, and we are still finding why it fell like this. But there is no panic. See, there's a very different one. I mean, with a 6-7% drop, more than 1,000 points drop, people should be running here and there, and people should be scared to death. No, people are so, so excited about this fall that we are getting opportunity to get into the market, and that's what we are seeing in the inflows yesterday, even bigger today. So my sense is that this is a very different one, and probably people don't think that we should have fallen. Maybe it is global cues and global inflows, outflows, but I think there's something to do with the globalized market system right now we have, where you see US future in the morning and you decide what should be the market trend. So in the short run it's all voting machine. In the long run, ultimately you'll make money if you pick the right stock and if that company actually makes a lot of money for you. So it's a weighing machine in the long run and voting machine in the short term. That's the voting is on big time. I mean, US, there is a problem in China, there is a problem in US, or say the rates are going up, or US future is up or down. I think even US market is voting a lot to the global, short-term fluctuations, and we have definitely followed. So this confusion, I hope it clears as the days goes by, but at least I don't see any permanent damage here.
So you're of the view that look, there's a problem in the world, we can't sugarcoat that, yeah. But the intensity and the magnitude of sell-off is largely emotional in nature.
Yes, I think it's more of a, first time I saw some technical guys saying that it is going to fall, and that too they are saying for last 3 months, and finally it fell. So I think this is by far the best technical call I have seen in the marketplace, and all the fundamental guys, they are finding good. I've read Bloomberg, I have seen here and there, but I have not found a good reason why market fell so much all over the world. I mean, not only China. Say China has a problem, so China fell by 5-6%, 7%, but India, Saudi Arabia, entire Europe, America, everything to fall by 5-6% at least. US to close open with a complete circuit down. At least I can't explain what is it, but market has its own mind. Maybe after 1 or 2 months we'll come to know how big is the global problem shaping up. Because India is not a small thing. India is not a Greece. It's a 10 trillion pound gorilla in the global economy. They are second important player, probably the most important player for a lot of industries, like all the commodities, the way they consumed in last 10 years. Clearly it will have a huge repercussion on those industries.
Now, you are of the view that value has emerged in this market. Why?
It's not that it has emerged because market has fallen by 6%. Values are always there if you are looking for one.
So irrespective of the fall, yeah, you are of the view that this market selectively is offering value for a stock picker.
Always. Even at 8,000-9,000 there were values available. If you give long enough time and you build a portfolio of 15-20 companies, good companies, which you understand that they are good and they are going to make money. First thing is, let's understand how money is made in the market. First thing is that you make only as much money as much as the company makes. Yes. If company makes abnormal money, you also make in the stock abnormal money. Okay, first thing is this. Second is that all these troubles will not stop the banks and the companies which are doing, with the franchises to make money. And once they keep making money and you give long enough time, yes, stocks will go down for some time or remain depressed, but over a 3 or 5 year period of time, it's a weighing machine. If the earnings have gone from 10 to say 30 or 40, stocks will take the trend earnings growth. So if it is 3x in terms of earnings, at least 3x will be stock, if not 5x.
But just to counter your belief here, and just to counter it here, what drives any financial market, at least equity markets, are two factors: liquidity and growth. Global growth expectations have got reset given what is happening to China, and we don't know what will happen to emerging market. Within emerging markets, you've got Brazil and Russia, which have got unique problems because they're commodity producers. Then you've got Turkey and perhaps Thailand, which have political problems. So all I'm asking you is that, are there genuine concerns about global growth?
See, Nikunj, the world is becoming very complex. It is actually very complex. We are realizing now with the internet and all that it's very complex. But investing is much more simple if you keep it simple. See, there is important information, there is unimportant information. There is a knowable information and not knowable information. Now you can work only in the realm of knowable. So knowable and important is where we should focus our 90-95% of the time. All this noise is important in terms of whatever countries and global economics we talked about, but they are not knowable. What is going to happen to China or Chinese economy or American? If I knew, or say if I knew that oil is, 1 year back nobody told us that oil is going to fall to $40, and yet it is there at 40. So what are the implications of that? So really, I mean, this was a very important information. 100 coming down from $110 oil coming from 100 to 42. Yet, what would have been your investment strategy at that point of time? You would have thought that India will be at say 60,000 index because oil is half. But where are we? We are year on year we are zero.
So the message what you're trying to communicate to our viewers and to perhaps some of your shareholders and unit holders is that you are confident, irrespective of the noisy global backdrop, your investment thesis and your belief has not changed.
Definitely not. In fact, it is reinforced. It is just reinforced that, see, fundamentally market moves between QG and KG, which I was talking about. Very high quality growth companies and very low quality kachara growth companies.
So where are we right now?
So, no. The issue is that what is your investment strategy?
Okay.
My investment strategy is very clearly QG. We will buy quality and growth.
But is growth
to best of understanding? No, it's not at individual company level.
Okay.
In fact, some of them are accelerating.
Okay.
Some of them are accelerating. We don't need 100 companies or 80 companies in a portfolio to make money. We need 15, 16 companies, and of that, I have right to go wrong in 1/3 of them.
Yes. Okay.
So if 10 companies do well, we are well off. If all 17 do well, then we will just bust all the charts.
Do you see more and more money will migrate towards high quality high growth companies? Because there's a growth scare. Very few companies are growing. If very few companies are growing where visibility is high, money will move disproportionately. Can that happen?
My sense is that market will have a two-speed market. One is the companies which became very large in last 10 years of Chinese expansion.
Okay.
China's growth has positively impacted some of the businesses. Commodities and whatever. I mean, export, import. If you are exporting to China, that might have done very well. The commodities which are underlying, they have done. I mean, some of them have become so large and so humongously profitable. See, if your marginal cost of production of say iron ore is $20 and you can sell it $180, you can imagine the amount of profit you are talking about. So clearly those kind of my sense is at one level the whole thing will go back to reset of 2002-03 when say oil price was $20, $25, $30. Iron ore price was $25. So all of them were in that $25 kind of thing.
You see a big correction in commodities.
Yeah, so commodities are going to go back home after 10 years of bull run. So that will have its own implication on the underlying industries, whether they get destroyed. And unfortunately, everybody is expanded and they have taken on debts in the books, which will be quite crazy. And particularly in a country like India where interest rates are 8, 10, 12%. I think it will be very unsustainable for this industry. So
avoid commodity producers, avoid companies which have huge debt on the balance sheet.
Don't have any generalized theme.
Okay.
Look at company by company.
Okay.
What are the problems they have and what are the prospects they have.
Okay.
There will be huge winners and huge gainers.
Okay.
Try to have few companies in your portfolio, but have you think are the winners. That's very important. That's what I think. And I think individual stock management has become very, very challenging. Because today what you say is right is becoming challenged tomorrow itself. Like if say ONGC was a terrific company a year back because they have all the oil reserves of India. Today the oil price is such that it is barely covering the cost of production. So despite the deregulation, they will not have the kind of profitability which was.
That's a great point.
So what I'm saying is that just 12 months can change your entire the competitive advantage or whatever they had. the source of profits. So we have to be very careful. We have to be watching our portfolio very carefully. So we cannot do a wonderful job if the number of companies are too many in the portfolio. Particularly in this kind of economy.
How
where
many stocks do you own in the portfolio?
I have always less than 20.
That's it.
So
you run a very concentrated portfolio.
Yes, I mean our managers run very concentrated portfolio, and that's a stated policy. But what I'm saying is opportunities are becoming fewer and fewer. To find multiple opportunities in the market is when the markets are booming. When the markets come back from a slowdown to this thing. So all the companies which are at the brink of death or collapse, those companies come back. They come back very strongly.
That is not going to happen now.
So I am seeing that to be a little away.
So you expect the market outperformance to become narrower and narrower?
Obviously.
It's not going to be like 2014 where everything went up. This will be a very selective and a very narrow market.
It looks like, if particularly if the world slows down, which is what is the broader commentary we are hearing on the back of China, because China is almost 15% of the world. 10 trillion on 75 trillion. And more important is that they were the biggest contributor to the global growth. Yes. If that is slowing down, and we don't know how much it has slowed down, is it growing at 7% or is it growing at only 2-3%? Nobody has any clue. But clearly it looks that growth coming from China is a big challenge.
Okay. So you agree with me that global growth is slowing down?
Clearly.
There's a deflation scenario.
That's what I'm hearing.
The data is indicating.
Yeah.
We can be challenging the data. But if global growth is slowing down, that surely will have an impact on outward looking industries, whether it's IT, whether it is pharma or textiles.
Sure.
Would you be a bit wary in export oriented things?
Yeah, so you have to go again company to company.
You cannot generalize it.
You cannot generalize it because Indian IT is not tech.
Okay.
Indian IT is a lot more services, it's the back office of a lot of these global corporations. So they are doing, they are shifting a lot more work to India, and now with the rupee being weaker, they'll be hopefully shifting even more. So, and it also depends on how good is the leadership in the company. And how big is the size. A $10 billion company led by a brilliant guy can be a big winner, and a $500 million company not led so well might be a big loser.
But in general, that wave which was there for IT, that wave will not be there.
No, it's there. India's there. This one industry, just look at it, what this industry has done for India. In 2000, it was a $5 billion industry.
Okay.
The world was 500 billion services market. We were 1%. Today, we are $100 billion export company out of a $1 trillion market. So we are 10%. In 15 years, we have got 10% share of the global services market. Now, services means India. Software means India. In next 10 years, when we go from 100 to 200, 250 billion. But in last 10 years or 15 years, all the incremental export revenue of IT was consumed by buying the oil incremental, because oil went from 25 to 125. Now when export revenue goes from 100 to 200 or 250 and oil remains say 60, 70 also, forget about 40, 75. What happens?
So what happens? Because
so you are going to, so the world economy will support you to go to the logical place.
Fair point. So let me throw in the oil part, the most important talking point. It's a dream scenario. God send opportunity. Oil is at $40. Is it time to reboot and look at oil consumers, paint companies, car companies? Essentially, do you think every commodity and oil consumer will gain now?
See, now it is question of competitive advantage. See, in any business where, yes, raw material costs has come down, but
working capital will come down, margin
that's
expansion
okay, but what happens is, what is your competitive situation? If there are 100 guys, say like in broking, if my cost comes down, but the 500 guys, everybody will pass it on. So I remain as poor as ever. But there is a company, say Eicher. Eicher in that segment of premium motorcycle, they are the only guys.
BMW is coming, Harley Davidson is coming.
Till now, in that particular 150,000, 200,000, they are the only guys. And their raw material cost is definitely coming down. Their tire price is coming down, the steel price is coming down, chrome price is coming down, every price is coming down. Yet, they are raising the price. They don't have, because there is nobody. If you want to buy that kind of bike, they are the only guys in India at that price. So you have to see the situation where it gives you pricing power, where it gives you margin advantage. Can you hold the benefit in your pocket? You know, so the industries where it is highly competitive and you have to pass it on, like say pipe industry, everybody is passing. Every Tuesday they set the price. If it goes up, they set it up. If it goes down, they have to bring it down. Yeah, there is no moat because of the price. They might have the moat of the scale, the brand and processing or quality. That is a different thing. But per se, because of falling raw material prices, they cannot hold it.
Okay. So, you've always taught me and you've indicated to our viewers that equity is nothing else but buying future pricing power. So stick to pricing power. I'm going to stick with the macro so that I can get a sense of what you're thinking. Government of India has announced slew of reforms for private banks, for PSU banks. Indradhanush, the 7-layer comprehensive scheme. Is that enough to revive them, or PSU banks are bad businesses? One should not focus on PSU banks. One should continue to nurture private banks. What's your sense?
Yeah, so again, the issue is the execution. Execution is one very important thing. How much management changes they bring, and is it a pilot? And because there are 25, 27 banks, I see the action around fewer banks at this juncture. The experimentation is on. So at least they have recognized that it's a big problem in the economy. That's the first big thing, because to solve any problem, first you have to know the problem. So clearly government has recognized it's a big problem and they have to focus on it. My sense is, my personal thinking is, it may not be sufficient, but it's a action in the right direction. And
but
one
it's
success
not enough to make you invest in that stock.
See, my investing style is very different.
Okay. I understand that.
Okay, I'm not looking at some very bad company becoming very good.
Okay.
Okay, I want to buy good companies or great companies who are because I am not running my prop money.
Yes.
I have a lot of money on trust, and my problem is I have forget about how much money it makes. I have to see how I save the downside.
Yes.
Because in investing,
margin of safety.
Yeah,
is very important.
In investing, what is important is not how much you make, how much you don't, how much you, how little you lose. Like Buffett's thought process. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So the downside has to be constantly, because my downside has to be limited, upside has to be unlimited.
So in this global environment, what could be the downside for Indian stocks? Fundamental downside.
Yeah, see, one is of course the global economy itself. If everybody says that, boss, we don't want to buy anything from any country.
Can it happen?
No. You said what can happen? A lot of things can happen. See, in 1 year before and today, if you go, so that's why forecasting is useless. Okay. But world will be far more. I know one thing. I'm optimist, and I'm telling you, 10 years henceforth, world will be far more prosperous. Every person in the world will have a lot more to spend. And corporates will have a lot more opportunity to do business. You see, today it is $75 trillion global economy. 7 billion people, $10,000 per capita. It's growing at 5% nominally. Okay, so in 15, 20 years, it will be a $150 trillion global economy. That's what is our future.
But if consumption is the way forward, because if global demand comes back, per capita income increases, consumption demand will always make a comeback. What I worry about some of the consumer names, whether it's a Nestle or a HUL or P&G, great companies, great franchise, great mod, great brand, valuations, Nestle 100 times, P&G 70 times, HUL, I don't want to even talk about it.
But why do you have to have a portfolio only of those companies?
Okay.
They're outliers. In any place you'll find few outliers.
So you don't like top consumer names?
You can see my portfolio. It's all disclosed portfolio. Yeah, we like them as great companies. Great
but not
businesses.
As great investments.
But not great investment, at least to best of my understanding. Though they've defied every single valuation so far.
Yeah.
So far that when you buy, it's about Q and G. See, they have a terrific quality of franchise, but G is limited, and hence what money you'll make in the future is also going to be much more limited. Like we did some numbers on a 20-year basis. Most of these companies, they have underperformed the index itself. Forget about making serious money. So
where do you think serious money will be made?
So that's
let me ask you direct in a simple question.
Yeah, so it's a dynamic situation. I'm not at liberty to discuss every single stock.
Of course, but I appreciate that.
Yeah, so but then there are opportunities. See, if you will make only your pace of making money will be equivalent to your underlying portfolio's growth in the earnings.
So focus on earnings. That's the ultimate mantra.
Market is slave of earnings power. There's nothing beyond earnings.
So give me 2 or 3 themes. I'm not going to get into names. I respect your compliance. Where you're confident of a 15 to 18% earnings growth.
Your private sector banks, well-managed private sector banks.
You think 15 to 17% growth is there?
Clearly.
Any other sectors?
I mean, that's one. Your well-managed pharmaceutical export companies. In pharmacy is again like IT has demonstrated. Some people, they believe that longer run pharma will be as big or probably bigger and stable, more stable than even IT. So still we are seeing birth of small global companies. The companies are starting with 200 crores, 300 crores, and suddenly they. So I think that's one space where you can find niche pharma companies. Okay. Small to mid cap but high growth companies. Okay. Pharma is one sector where you can find. In the technology side, you'll find in IT. I think best of Indian IT is yet to come. What you see in the services, but the products and some of the concepts, some niche services, because see, internet is only 10-15 years old.